time to shift focus onto a fundamental conversation. Pankaj Murarka joining us, and he's CIO Renaissance Investment Managers, needs no introduction. Pankaj, very good morning. Let me first start off by setting the context. Where are you seeing markets at this point? You're not particularly enthused about the markets over the next 12 months either. My understanding is you're expecting single-digit, late single-digit to early double-digit kind of returns. Why is that so? Because, Pankaj, we've seen a large consolidation, right? So where is it that you're seeing the likelihood of a lag in terms of returns?
Well, morning. My view is that, actually there's a downward reset that has happened in the economy. 4 years out of COVID, India was growing at about 8.2%. It's been now last 6 quarters, the average growth rate is about 6.8%. And my view is that for the foreseeable future, given the fact that we have global headwinds in terms of what we have for trade headwinds, given the tariff environment that exists globally, and I think that will going to persist for a period of time. And also I see US economy weakening and a global growth weakening out next year. And so global growth will remain weak. And in context of that, I believe that India is a 6.5% growth story. While this year, if you look at calendar year 25, earnings growth for, let's say, Nifty companies just about 2%. I think when we look at calendar year 26, our internal estimates are that we're looking at about 11% earnings growth. So that's a significant improvement from where we are. But the fact that India is the most expensive equity market in the world outside of US, I think markets are priced for perfection. So I think what we should be looking forward to, or what we're looking towards, is about low teens kind of returns over the next 2 years, which I still think coming in the 6th and the 7th year of a matured bull market are still reasonably healthy. So markets are priced to perfection. More importantly, Indian markets are extremely polarized. On one end of the market, you have stocks which are extremely expensive. And a lot of these stocks have a lot of momentum riding on, near-term earnings growth. And at the other end, you have stocks which are value, which have not done well in the last, few quarters or few years, but still offer a lot of immense value. And these are companies which are generating a lot of cash flows. So at this point of time, which is classical to happen at such a late stage in a bull market. It happens in every bull market. Market overlooks cash flows and markets are chasing near-term growth. And which is, I think there's a fair bit of froth as well in markets. So to summarize, my view is we can still do, I think markets will still do low teens kind of returns, about 13-14% over the next 1 year. And which are, I think at the index level, are very healthy returns at this stage of the bull market.
Pankaj, you're indicating froths. Where within the market? Large cap or broader markets? Where is your comfort lower?
Well, obviously, large part of that froth is in mid and small cap. There could be pockets of large cap we see that froth, but more than it's specific pockets of small caps and mid caps where you see that froth. For example, while defense is a great story, but every defense company is a 70 or 80p, meaning I don't know how to. I have not yet learned the art of making money from a longer term perspective by buying stocks at 70, 80p. And being a value investor, I find it difficult to invest into these companies at that kind of multiple. Likewise, meaning we've been fairly negative on this whole EMS story in that sense. We cashed out of that almost a year back. And I see a lot of reflection of the infra companies into all these EMS companies because the kind of work they're doing is extremely commoditized. These are companies with low single digit margins. These are companies with, negative cash flows. So effectively, while they're delivering high revenue growth, but to fund that growth, they'll either have to borrow or they'll have to raise equity because eventually they're consuming capital. They're not generating capital from the core business. And given the fact that what they're doing is fairly commoditized, they have a window of 2 to 3 years where they get this PLI incentive from the government. But beyond that, that edge is lost. And the fact that remains that the underlying business commoditized, the margins will never improve meaningfully. And all these EMS companies are trading at 40, 50, 70 multiples, which I can't put my head around. So obviously, meaning I've given you a few examples. Likewise, there are many pockets of markets where there are froth that exist.
Interesting. Pankaj, so much happening actually in the market. But if I just draw inference from what you're saying, would you say that the next year would be about the bottom-up stories, as one can see play out in IT perhaps? Not much to lose, rather than how much more to gain from here?
Absolutely, Aisha. Meaning I've been invested into IT, and this year has been a bit painful because the stocks in the sector is down about 17-18%. But I think we'll see a main reversion next year. These are companies, one, growth rate for the sector as a whole will improve. Uh, Secondly, I think AI as a technology where in the first 3 years or the last 3 years, uh, uh, all the investments are happening on the infrastructure side, be it the semiconductors or in the cloud and hyperscalers. Eventually, we're getting to a stage where adoption of technology is accelerating. And when it comes to implementation, I think Indian IT companies will be a big beneficiary of that. I've been calling that out for a while, that AI will accelerate growth for Indian IT companies and it will not impact them or negatively impact their business models. And more importantly, valuations are very reasonable, meaning you have companies like Infosys, which are paying out $2 billion cash to shareholders in terms of buyback. So these companies are classical cash machines. So I certainly think next year will be a year for IT as a sector. More importantly, from an investment framework perspective, we believe that next year will be a year for companies which can generate free cash flow from the business. Last 2 years of this bull market so far has been about growth, where markets have been overlooking cash flows and looking at growth over the next 4 to 8 quarters. But I think we're nearing the peak of that story. And next year will be back to basics, mean reversion, in getting back to cash flows and free cash flows. And companies which can generate those cash flows are the ones which will do well.
That's a long list actually, because we also were doing this exercise internally. And I mean, one name which popped up was also Interglobe Aviation. While it's still work in progress, the story is still developing, but just the cash on the books. Would you say even stories like Interglobe Aviation should be looked at right now with that eye, that they have sufficient cash on the books? It will take years, if not a decade, for anyone to come into that kind of position and eat into their market share or even reach that kind of size. So the correction right now in Interglobe perhaps could be a good buying opportunity.
Actually, yes, but given what's happened with their operations and all of that, as an investor, I would like to wait out for a while for them to, fix their operations and get slightly more confidence in terms of they having fixed things. Eventually, the way see things playing out is eventually this market has to broaden, and I think the government has realized that the challenge. So I think probably Interglobe will have to concede some market share over the medium term. Having said that, structurally, India still remains a market which is grossly underpenetrated. It's a very strong brand which has done phenomenal in terms of execution over the last 20 years that they've been around. So I'll just wait for a while for them to set their house in order and get more confidence in terms of, having got over these problems and fix their operational issues.
Pankaj, I recall you were the first ones, or one of the first ones, to identify the entire consumer tech platform businesses. Given the recent spate of IPOs, that space is beginning to broaden up a fair bit. Anything that's still looking interesting? And I ask because, some of these IPOs are coming at absurd valuations. So wondering whether you've been a subscriber to any of these.
So one, I've said this time and again, I'm a perma bull on the space. So for the next 10 years, I'm going to remain positive on the space. Yes, it's a space where we'll have to pick and choose companies because in each and every segment, it's all about winner takes all. I've said this, the way these internet businesses operate is they because of the intense competitive intensity through which this business come from and the way they drive the business with the intensity, they drive industry consolidation at the early stage of the evolution of those businesses. So eventually, when these businesses reach critical size, they transform that industry into a oligopoly kind of a structure. And in one of the simple, mental model of investing is one should go out and buy businesses which operate in an oligopoly industry structure, because the profit pool on those kind of industry structure always remain very guarded and it keeps growing. So yes, to that extent, I think the construct looks very favorable. As I said, it's a business where winner takes all. There, meaning some of these IPOs, the recent IPOs, looks like somewhat mispriced in terms of valuation. So I think from a longer term investor's point of view, I still think that one should wait for a better entry point, because we being inherently value investor, we want to, it's in our DNA to buy a dollar for 50 cents. So probably some of these businesses in the near term looks like their pricing is much more elevated given the euphoria that's going on in the IPO market. But I think a lot of these business models are looking very exciting. And having said that, I still continue to remain very constructive on the whole food delivery and quick commerce space, and we own companies within that space.
Oh, very interesting. Okay, Pankaj, I also wonder what you think of the EMS basket, because you've suggested that you're not exactly comfortable owning businesses which trade at price to earnings ratios of 70 times plus, and making money on them is difficult. But this is a space where it's extremely fast growing, and recently, of course, one of the names had a bit of a crisis with regard to corporate governance. I wonder whether that at all is something that worries you in this space.
To me, all these EMS businesses, when I, try to accumulate and think through all my investing experience, are a mirror image of infra companies of 2005 and 6. These are businesses which are operating at a very low operating margins. The kind of work they do is extremely commoditized. They have a window of opportunity because they get some incentives from the government through the PLI schemes. But eventually, these businesses are consuming more cash than what they need more cash to run the business than what the business can generate, which effectively means every year to sustain that growth, either they have to borrow money through taking debt on their balance sheet, or they have to come back and revisit shareholders. As value investors, we like companies which can give money back to shareholders and not call for money from shareholders. Eventually, businesses which keep calling money from shareholders eventually tend to derate significantly over a medium term to long term, which is what we saw happen with infra companies. So I think eventually these businesses, one, they cannot sustain this pace of growth because shareholders are unlikely to fund their growth every few years. So they'll have to settle down to a growth model, the growth is to a rate of growth which can be sustained with their own internal cash flows. And once that happens, automatically, as the growth moderates, valuations will go for a toss. So one of those two things will happen. Either if they want to sustain the level of growth, they'll have to keep calling money from shareholders. And I'm sure some point of time the shareholders are going to raise their hands. And if they try to build a sustainable business models, then growth rate will moderate, and as I said, valuations will moderate. So I certainly see a lot of froth in that space.
Quite interesting. We should have a longer discussion with you, but unfortunately, I'm going to have to let you go, Pankaj. But thank you so much for your time today.